I'm going to call to order the SHAPE Committee meeting of Wednesday, February 7th at, looks like 6:45, thereabouts. Roll call.
Chair Smithers.
Here.
Vice Chair Chateau.
Here.
Committee Member Barr.
Here.
Caldwell.
Here.
Dell. Feeney.
Dell's here.
Okay.
Good.
Is she here? Yes.
Feeney.
Yes.
Knight.
Here.
Neiman.
Here.
Park.
Here.
Sylvestrin.
Here.
And Smith.
No, it's on.
He is here.
Green light?
He'll be here in just a second. Okay, so item 3, public comment. If there's anybody out there that'd like to address the committee before we get into our other business. Okay, I'll take that as a no. Number 4, we have one consent item, which is the approval of the minutes from January 24th meeting. Anybody have any comments or a motion?
A motion to approve.
I'll second it.
All in favor?
Aye.
Aye.
All opposed?
Okay. So on to new business. We have the Kosmont group here to make a presentation on asset strategy and financing and that sort of thing. And Mark, do you want to? Okay, you're going to.
Just a brief introduction. Mark Prestwich, City Manager. Tonight is a continuation of the information process and stages that we've been going through. And I'm pleased to tell you that we're about finished with that. So when we get to the next meeting, we're going to begin talking about decisions and moving forward. And I think we had a very good meeting at the last time. And you have a handout that summarizes the feedback that each of you provided, and that's on the dais tonight. Tonight we are going to hear from a company named the Kosmont Companies. This is a firm that the City Council has hired to assist this committee with decision making, looking at various options. They'll be able to put numbers and identify whether some of the ambition is achievable from a financial perspective and help this committee as it moves forward. We've scheduled 3 touch points with this committee, so this is the first of 3 visits that the Kosmont team will join us for. Tonight, our focus is to provide you an overview of various asset strategies, both in capitalizing assets but also on the maintenance side. So we have a good presentation planned. Ken Hira will be representing Kosmont tonight. He and I had a chance to talk last week quite a bit in Southern California when I was away at a conference, and so I've given him some good feedback, I hope, on this committee, some of the challenges that await the committee and the town in general. So with that, let me introduce Ken Hira.
Thank you, Mark, and Mr. Chairman and members of the SHAPE Committee. It's a pleasure for us to be here. My name is Ken Hira, Executive Vice President of Kosmont Companies. My colleague is with me, Tom Jarofsky, who's a Senior Consultant, and it is our pleasure to present and discuss, frankly, a relatively high-level asset strategy presentation that is meant to impart some of our experience, specifically with other communities, but a general overview of an approach, which is kind of what we've been come on board for. So tonight we'll do some of that speaking, but at the end of the day, we also want to be good listeners because it'll be your caucus as to how you want to approach your assets. We just want to give you some of the tools. So let me get started on that. And we've got about 12 or 13 slides. I hope to get through that in maybe 10 or 15 minutes. You're welcome to ask questions if you want to wait till the end. The one thought was we're definitely available to sort of address those questions. So, it's pretty open. It's pretty fluid. But I can get through the 12 or 13 relatively quickly. There is a bit to cover, so let me get started. Just at a high level, Kosmont Companies has been around for 32 years, based in Southern California, has been working in California for that period of time, and really working with many communities on real estate, asset strategies, economic and community development, infrastructure, and public-private transactions and financings. Our role really for the city, as I mentioned, is we're here to assist and support the SHAPE Committee in trying to make some decisions and have a discussion about a variety of variables, and I'll go through those. One, which is the majority of what we'll talk about tonight, is sort of our view of best practices when it comes to asset management. The other is to touch on the economics of real estate. And we also want to share with you some pros and cons of some of the decisions and the impacts of those decisions that you all will make at the end of the day. Provide a high-level menu of some public finance options, and then know that really where we want to end up with is an asset prioritization. So it's a decision on your part to really prioritize the approach to your asset strategy. So we're here as a sounding board. We're here for ideas to help on the decision making, and also know that we have reviewed relevant documentation and reports that have been on the website, that have been provided to us with staff. We've worked closely with staff. And so we have that in our repertoire. And then also today, Tom and I actually had a chance to tour with your public works manager all of the real estate assets. So it was a very, very helpful visual of those properties and where they are also in juxtaposition to each other, and sort of the condition that they're in. We understand that you had another firm come out and do really a physical report, and that's not what we're here for, but we did get into a little bit of the physicality in some of those issues. So it's very helpful for us and insightful when it comes to helping you all with an asset strategy. So here's our approach, best practices. There's an set of action items or an action plan on slide 3, which is followed by sort of a overview of a financial plan. So from an asset standpoint and best practices, we think first and foremost what's important is for the community to assess its needs. And we'll kind of call that a needs test, if you will. That to us is at least an important step, or step one. Secondly, there does need to be an honest assessment of those assets. So we call that a highest and best use analysis, if you will. That's something we do as a consultant, and it's something that really is going to be critical to this process. A frequent question or a frequent issue and matter that really makes a difference in highest and best use is density. So density ends up being, in many cases, the key to feasibility. The question here for you all in your community is, what's the right threshold? And so if you want to call that sort of a density test or a land use test, that's a second component of the action plan. The third is really specific to your departments and really understanding how operationally they work together, and eliminating duplication when it comes to that, as well as trying to create an efficiency with respect to the operations of your city. And so we might note that as kind of an efficiency test. And of course, all of this needs to be synthesized into an action plan with timeframes. So time is a really important component to this in terms of how you move forward and make those decisions. From that action plan, there's really a financial plan. So our view of best practices when it comes to financing is understanding current available capital sources in the marketplace, understanding your long-term capital requirements, evaluating the potential for your community to increase your tax base. And I think what's important there is a sensitivity or a balancing act with what we call quality of life. So you can have this plan to increase your tax base, but what comes with that is development and traffic and congestion, but what comes with that is revenues. So we need to understand at the end of the day, how does that balance well for you all? And then from a revenue perspective, we're just highlighting some revenue sources in the financial plan. Long-term ground leasing of surplus real estate, right? You can sell assets. You can enter into tenant leases, which is a revenue stream for you for buildings that you own. And then the important factor there is timing again. It's considering market conditions, because we are in a cyclical world and we're in a cyclical business when it comes to real estate. And then, of course, from a maintenance and operations standpoint, it's important to have those appropriate formulas on how those properties should be maintained in terms of where they are in their useful life, And then lastly, be very conscious of capital improvement reserves. So this next slide is an illustration, and it was an attempt to try to highlight, depending on priorities, asset priorities, and the cost of a particular project that might be desired on your part, where would you fall in a spectrum? So I don't want this to be confusing, but I'll give you some examples. The top left, which is this red dollar sign, is an example of a project that you might say is number one priority. And it needs to happen early in our time frame, but it's got a high cost. So the consideration there, just simplistically put, is if it has a high cost and you want to get it done tomorrow, it's an expensive proposition. It's going to require some debt. And that's a consideration. If that high cost asset or project has a longer term scale to it and time frame, there's a way for you to plan for that to raise capital. So that's why we kind of put the green and the red dollar sign. So this is just an illustration. Ideally, I think it would be great if we could take your assets as a function of your input and your direction and your decisions and maybe map them on a graph like this. We've done it before, where we say number one priority is X, but it's on a low cost basis. Therefore, we know we can raise those dollars. Maybe it's a park improvement. Maybe it's a simple landscape or street improvement. Maybe the high cost priority, which could be something early on in your prioritization, is the building of a new public facility. And so it's going to have a different capital intensity and a different requirement in terms of a capitalization strategy. So that's what this was trying to do, is just to put on one scale project cost and debt, and on another project timing and priority. From a real estate standpoint and the economics, real estate has a broad base of revenues and funding and financing sources. So from an asset standpoint or an asset-based strategy, we talked about revenues. You can gain revenues from land sales or property sales. You can gain revenues from long-term income, ground leasing or leasing. The idea of a tax-based or tax or fee-based real estate strategy is you're going to get revenues from property taxes, and that's that tax base we just talked about. As your tax base increases, our calculation is that you get about $1,600 per $1 million of investment. And that math is simply taking an asset that is on the tax rolls times a 1% tax rate, and then your property tax share of that as a city, which is about 16 cents. Hotel TOT revenues, another way to generate income. We kind of looked at it from a standard room rate standpoint, where you might gain about $12,000 a room, and also from a more luxury hotel room standpoint, where you might gain $25,000 per room in TOT. The concept there is if a hotel is leasing rooms out for $300-400 a night, that TOT is going to generate X. If you have a luxury hotel that's leasing rooms out at $700 or $800 a night, there's going to be a much higher TOT revenue stream. And then, of course, retail. Retail sales, as you know, comes at a 1% rate, but you also have an additional measure that you've added, which is another half-cent sales tax. So you're getting 1.5% of your sales tax revenue from dollars that get spent, from people shopping in downtown, buying wine, coming to stay in hotels, and spending. And then lastly, there's the idea of impact fees, which is inclusionary as part of your building permit process. The last category is the public finance and funding mechanisms, which include, and we've just listed a variety, and I'll get into more of those here in a second, but as an example, there could be things like community facilities district to pay for infrastructure that's needed. Special districts, as an example, like bids. And then there's, of course, lease-back, and certificates of participation, which, again, we'll talk about in a little bit, and P3, which is your public facility delivery methodology. So that's just a high-level overview of real estate economics. We specifically looked at your existing conditions. And this is just a summary of the way we see St. Helena. So number one, you're in good financial standing or shape, if you will, with almost no debt. Your Measure D alone is going to generate a significant amount for your general fund, estimated to be about $1 million for a year. The Napa Valley, of course, is a significant draw for visitors, which continues to be a source of interest and revenue, in your community. And, financially, you have a pretty healthy diagnostic. And, of course, the fire department staffing is a long-term cost impact, which is something to keep an eye on. EMG, the company that did your evaluation, evaluated about 10 of your properties that amounted to about 70,000 square feet with appraised values and also a needs assessment that, in their estimation, was about $2 million on the short term and about $8 to $10 million in the long term. So that goes back to that chart that I showed, is if we believe the needs assessment, which I think we should all take a close look at, there might be some short-term needs and might be some long-term needs. So it's really mapping out that financial requirement that will, I think, be part of this exercise. We use the City Hall and Police Headquarters as an example of a potential priority concern. And some of the options there, as noted, can be the rehabilitation of that building. It can be the rebuilding of a brand new facility, or it could even be the leasing of space as an alternative. We mapped out many of the city properties. These are not all of them, but many of them that were kind of on the radar for us with some appraised values, just as a summary, so we understood where they were and what their values were. And then we provided a couple of case studies for you. So I'll go through these quickly. Number one, we worked on this Oxnard fire station, and it turned out that it was a lease revenue bond financing, and it's more of what we'll talk about on the financing side, but it was a way for the city of Oxnard to mitigate their risk and construction risk and have a third-party nonprofit LLC bring to them a public facility. So we assisted with that. There was the issuance of these lease revenue bonds to the tune of about $15 million. And it was a success story for Oxnard, which was in need of a fire station. You have your fire station, and so you have your own success story from that standpoint. But there's other P3 delivery methodologies that we can think about and financing strategies. In the city of La Quinta, which is in LA County, just a different example of their need for a city hall. And in fact, they took over a vacant and defunct sports chalet building, which was kind of an interesting alternative for them. But it was a lower cost strategy and lower cost solution in that instance. We put together this matrix, which is really about these decisions that I mentioned earlier. And there's pros and cons to those decisions. This can kind of be broken up into a couple of categories. The first line item is, say, one category. It's really the do-nothing strategy. I also call that the ostrich strategy, which is you put your head in the sand and you do nothing. It's a maintenance approach to your city and to your city assets. It's a very low-cost option, but you're also losing the upside to either revenue streams or really improving your community at the end of the day. The second two are with respect to what you do in terms of your need for new public facilities. So one approach could be to lease space, lease office space, instead of building a brand new city hall, let's say, as an example, or building a brand new police headquarters. It's a relatively small capital outlay, which is the good news. And of course, if there's bad news, or the con side of the equation, is when you lease, there's high operating costs, and you really don't have an asset that gains value, let's say. The third line there is the flip side of that. It's really building new facilities, and it's a longer-term solution, but there's a requirement for a pretty significant amount of debt or cost. $5 million, $10 million, we have to come up with that number. The next two lines are with respect to your properties that you control and what you can do with those properties. One, you can sell them to a third party. That gains you a significant amount of capital with which you can do a variety of things in terms of investing back in your community. But when you sell it, it's gone. Or you can lease that surplus real estate, and the benefit of that is, you're securing a long-term revenue, but you've really lost the asset more in terms of the control of the asset. And lastly, the concept of allowing new commercial development. So that real estate decision is you get significant city revenues as a result, potentially, again, on the tax-based side of it, on the revenue-based side of it. But with that comes traffic and congestion, those other things I mentioned earlier. That kind of goes back to the density test or the land use test. So it's a matrix. And so, there's no right or wrong answer to it. I've got a couple slides on public finance, and it's really a menu of public finance tools. St. Helena, again, in good financial standing and good financial health, I think has options when it comes to, do you want to go into the marketplace to leverage the traditional sources of financing that are available, like general obligation bonds? I think that might have been one of the means by which you used for your fire station. Lease revenue bonds or certificates of participation. That's sort of a lease-back strategy. That's how we did the Oxnard fire station for the city of Oxnard. Enterprise revenue bonds, where you have a utility which can issue bonds that ends up getting rated. We did that in a city in connection with a shopping center that got built. There's assessment districts and CFDs, which I think everybody's sort of familiar with, and then bond anticipation notes, which is really a short-term gap financing, usually used in the case of a phasing of a project, short-term type notes and debt. Lastly, I just want to close with our colorful picture of what we call sort of entrepreneurial tools. And I'll start actually with the existing tools. So tools we've used, with other communities. And one that comes to mind, obviously, for St. Helena is the idea of real estate. The city owning or controlling real estate and property puts itself in a position where you automatically have a tool that you can utilize. There's rebates and revenues. There's P3 projects. I don't know if you guys had a redevelopment association. I don't think you did. But we know that RDAs are dead. Stay tuned on that. There's grant sources. There's also land use strategies as tools. We use this pretty significantly in city of Buellton, which is in the Central Coast. And we did a specific plan with a development opportunity reserve where the city controlled the density and made decisions as a function of a trade-off of community benefits and density that it gave to the private sector with a trade-off. So the other part of this slide is really the newer tools. And one key new tool is the idea of the digital platform. So we've talked a lot about having opportunity sites being posted. So many cities are doing this so that you get access to the private sector and potential investment because you're trying to promote a particular site for a particular purpose. And the other is something we call DigiConversation, which is really more geared toward expanding a conversation amongst your community so that there's input citywide. And there's a dialogue between the city and the constituents. And a lot of that has to do with how people are communicating today, which is through social media. Lastly, our thought process on sustainability in housing districts is there's recent legislation that has really brought about a significant number of tools, including infrastructure financing districts and a lot of housing bills that are really allowing for workforce housing and affordable housing. And this Neighborhood Infill Transit Improvement Act is one where it actually allows sales tax to be used to bring housing to communities. So there's a lot of new housing bills and tools that we're also finding are more current versions of these entrepreneurial tools that are all at your disposal. And with that really wraps up kind of the approach for tonight. And I'm available for questions. Tom and I are available for questions or any feedback.
Excuse me. I had a question. Could you go over the P3, what that is and how that mechanically works?
Sure. So it's called P3 because it's trying to refer to a public-private partnership, but it's really the delivery of a public facility where a city could, in the case of Oxnard, lease to a third-party nonprofit entity who builds and delivers a facility at no risk to the city, and you are at the end of the day paying rent, which is the equivalent of the bond issuance that was used to pay for the improvements, and that is lease revenue. And the marketplace underwrites that lease revenue and underwrites, say, your credit, whether it's the city or an entity that gets created that does it, underwrites that credit and gives you the benefit of a low interest rate to finance a facility that you took no risk on.
So you basically contribute the land to the third party, they build on it, then you pay them rent equivalent to what the bond issuance is. So
Correct.
instead of coming up with construction cost, you're just paying, renting some money and then giving that to them for the rent for the building, basically.
Correct.
Okay,
Yeah.
thanks.
But they own the building, and at the end of the lease term,
City owns it.
the city owns it.
Yeah. City gets it back
The city does get it back.
because you've basically paid off the note.
Okay.
You've paid off the debt. So it's your facility.
And is that an easier mechanism than just borrowing directly?
Well, there's pros and cons to it. You may want to be in control of your issuance of a bond. Maybe you do a general obligation bond as opposed to having that third party. You may want to build it yourself, build a facility yourself. You want a contract for it. You want your public improvements, your public works. So there's that difference. I think there's a nuance to it.
Who pays for the maintenance during the years that you're paying the rent?
The city does.
It'd be a triple net lease, right?
Yeah.
Yeah.
Can you walk us through the general obligation bond and the lease revenue bonds?
So that example just now was the lease revenue bond. Also, there's a certificate of participation, depending on what entity ends up really issuing the bond. The general obligation bond, let me go to that for a second, is really a bond that is an increase in tax, right? It really shows up on the citywide tax bill. So the voters, I didn't touch on this per se, but the voters have to vote on a two-thirds basis to really agree. And you've probably seen these on ballots, of course, but the citizens and the voters citywide really need to agree that we're willing to have increased taxes because it's in addition to your 1% levy. So it is an additional tax. And that's
So
how
for instance, when
it's
we did the
financed.
fire department,
Yep.
that's what we did. We floated a bond. It got attached to the property taxes, and then it got paid back. And I think it's now almost entirely paid back.
Right. How much was that? I don't remember. Yeah. It might have been in that neighborhood.
Do you know what it was?
I just want you to speak in the mic.
Oh, sorry.
April's going to look that number up for you and give that to you in just a moment.
It might be in a similar range. I mean,
Mr. Herman, would it be fair to say that the P3 is favorable to towns that have bad credit rating?
Well, let's put it a different way. I think you gain the benefit of your credit rating in doing a traditional bond offering.
But let's say you can't get favorable rates because you're
Yeah.
so
Yes.
you're up against the wall. So you go for the P3 model.
Yeah, that's another way of getting around it.
Okay, I was trying to figure out what the attraction is. Yeah.
Right. That's another way of getting around it.
Okay.
Yeah.
Thanks.
I think there's one other advantage that some cities have, which is that by having the private sector do the construction, they're able to get it built in a much faster time frame. So that was a major consideration in Oxnard, was the ability to get the fire station open within a 2-year period. The city had estimated that if they had to go through their public works, it would have taken 4 years.
Does the prevailing wage still apply in this kind of situation?
Yes.
Okay.
Do they also have to take into consideration some of the things that I know, like if we build a city hall, the costs are usually higher because it has to take into consideration, I don't know what the term is, but or are they able to build it?
Well,
I hate to use the term at a lower standard. But
No, they have to build it to your standards. I mean,
Okay.
you design, you approve the design. They can't come in and put a Class C construction. I mean, but they have to meet all of the requirements. It's just that it's essentially what is perceived to be by many communities a faster way of getting something developed than through because many city staffs aren't, especially for smaller communities, aren't well equipped to be able to process a large construction project.
Question on the P3 model. Thank you. Does the investor developer gain equity at the end, participate in equity, or are they mainly gaining from the cash flow?
They're really gaining from it's kind of like I don't know if you know the term, a fee developer. They're really delivering a product, and their profit is I think, inherent, say, in that project cost.
Yeah, so part of the debt that they're being repaid is their developer fee. So if it's a $15 million project, they may have $1 million fee built in. They're getting that amortized over the life of the lease.
Thank you.
And also, just another point on P3 and the delivery is, again, it's that risk of construction cost and, say, overruns, because you're kind of getting a guaranteed price from that. So if you build it yourself and you feature some hiccups. Now, I'm sure there's some governors from the standpoint of the entity that says, I'm going to deliver force majeure or other things, but it also allows you to try to mitigate your risk, construction risk.
One last thing. What's the typical outcome if either party defaults?
That's a good question.
Litigation?
Yeah. It's kind of the same question of when you say if either party defaults, is one of those parties the city?
Well, I don't know.
You mean if let's just say a city defaults on its lease payment, revenue payment, if you will, you have bondholders, right, that will have a claim. I mean, that's a lawsuit for not fulfilling a bond obligation. That's, relatively, I'll call it, not standard or typical, but there's going to be those remedies in terms and conditions.
And if the developer defaults on the lease?
Well, I think the question is if they don't deliver.
Yeah.
Right, which is a great question. So, I mean, I think that there's probably a performance bond. I didn't do the Oxnard deal, but I think there's probably a performance bond that gets put up or a construction bond that gets put up. So you can capitalize on that if they were to not deliver. That's the way you would have any contractor or even a developer, say fee developer. I think that's how you'd enter terms with them. It's to make sure there was a performance bond.
You've listed an interest cost of 3 to 4% on a general obligation bond. In light of current financial conditions in our country, would you assume that's going up?
I think the general consensus is that interest rates are headed up modestly. I don't think anybody expects them to be up more than 1/4 to 0.5% over the next year to 2 years.
Quick question. On the options matrix on page 10, the pros and cons of different decisions, could you expand on or add a line in there, hypothetically, on a mixture of renovation along with leasing and or building?
Yeah. Yes. It's kind of like the middle dollar sign here, in a sense, because there's a combination of the ability to not have a high cost proposition, but combining that, right, which I think is very reasonable to assume. You may not build all brand new facilities for everything you need, but you'll be thinking about maybe the combination thereof relative to the overall capital requirements. So when it comes to the options, it's almost like combining, lines 2 and 3.
Yeah, I think it's important to note that we didn't mean to imply that these decisions were all or nothing, that you would
Right.
do this or that, but that it would be kind of on a per asset base, that certain assets that maybe makes more sense to sell versus lease, et cetera. And so obviously a combination is an excellent strategy.
Yeah. And, that goes to the same, thanks, Tom. On the do-nothing strategy, I exaggerated that as if you would do nothing on all of your properties. That's not going to happen. But if you do that, that may be in combination with, hey, we are in do-nothing mode with this particular property and this asset, which is fine as a decision, because it may be in combination with some of the other strategies.
Yeah, it would be a mixture of maintenance,
Yep.
renovation, and/or new construction.
It can be all three.
Thanks.
So on that same chart, I had a question. On the do-nothing scenario, in the con, you said lost revenue, and I didn't quite know, how are you getting there?
Yeah, maybe that the shorthand maybe got a little confusing. What we were trying to say was that there's a loss of revenue from a result of a recession. That under a do nothing, you're basically saying we have enough money to get by, so let's just do nothing. But in the event of a recession, you're going to have a lot less money, and then now you're going to be in trouble. So that's what we were.
But how would you be in better shape if we entered into a recession and we built a new city hall? I don't know.
No, you're right.
Okay.
We were focusing more on the revenue
Okay.
aspect
All right.
concept of. I mean, just borrowing money is not a solution to solving all the problems. I mean, there has to be capital raised to do any of these strategies that we're talking about. So.
Right. So continuing on that chart, how do you guys have an idea how many cities have you worked with where you actually see them lease office space versus building or some other way, or owning? Do a lot of cities lease their office space, their city hall, or?
There are. I'm sure within the hundreds within the state, there are many, but it's a small percentage, and it's typically smaller cities, and I think Malibu, for example, I think they lease their office, their city hall space, and it's usually maybe more for a short-term issue in terms of them being able to complete a long-term master plan of a civic center.
Okay.
Mark, can I
Yeah.
speak that to you? I'll give you two examples. It's a great question. In Southern California, there are two relatively new cities in the area known as the Inland Empire. It's Riverside County. One is the city of Eastvale, which is off the 15 corridor, and it's a city that experienced tremendous growth. I'm just giving you the story. Residential growth, retail growth, just tremendous amount of growth in a short period of time in these last 5+ years, because it's a relatively new city. They're leasing City Hall in one of the shopping centers from a developer. This is fascinating, from a developer who's done most of the development around the area. So they said, we're this new City Hall, and they are packed, to the gills in that space. Mm-hmm. They're working on a new City Hall because they're trying to figure out, A, they need to grow, B, they don't want to lease anymore. So they're trying to work with, frankly, the same developer in locating themselves nearby. And then the city across the freeway, a city called Jurupa Valley, which was also part of Riverside County, was leasing space in a shopping center, same story. They ended up taking over an old boot barn building, which is not far away. They rehabbed it, did a great job. That's their new city hall. So, and they control that real estate. So those were pretty interesting case studies for where they were leasing. I don't think ideally in the long term it's what they wanted, because they wanted to control their property. But for that period of time, it made sense for where they were. So it was, these aren't bad solutions.
In the lease scenario, lease surplus real estate to a third party, obviously for them to improve it. Typically, how long do those leases go? And at the end of the lease term, do the improvements revert to the city?
It depends on how long the lease is, but you would negotiate that, in terms of how long. You would want those to revert, depending on what those improvements were. I mean, if someone said, I'm going to lease your property for 50 years, it's a question of how they maintain it and then what you get back in the end. It's going to be tough to have a real short-term lease necessarily, but I mean, and then retain those improvements. But it also depends on what your goals are in leasing that in terms of the terms.
Right. My experience, done a lot of leasing in various marinas and airport districts, and if you have a very high-level, intense development, developers would often want leases in the 60 to 70-year range. It would revert back to the public landowner at the end of that term in all cases. Now, if you're putting up something that's a very low capital intensive building, say it's a warehouse, a stainless or some kind of a warehouse for storage, well, you might be able to get by on a 20-year lease with that because they can recover their investment fairly quickly. So it kind of depends on the amount of capital involved as to the length of the lease. But the more expensive the asset being developed, the longer lease they're going to typically want to negotiate.
Couldn't you offer a ground lease like that with some semblance of control on what's happening with the property?
Semblance of operating control, or
Use your microphone.
Specifically, what might be built there? Couldn't you?
oh yeah, well, you negotiate the development. You
negotiate
negotiate the development details like any other project,
Sure.
and they have to meet all of your requirements as part of the negotiations on that. And you can insert standards of maintenance that would put them in default on an annual basis if they don't maintain it.
Do you have a sense for whether cities are opting more for leasing long-term leases versus selling these assets? I mean, given the high real estate values in California, it always feels a little scary to unload land. Where are cities coming down on that decision?
So I missed the first part of the question.
Well, given you have surplus real estate and you want it developed, where are cities coming down on the decision of whether just to sell it outright or to try to engage in a long-term lease?
My experience, not just cities, but most public agencies, being universities, harbor districts, airport districts, transit districts, they are strongly in favor of long-term leasing. The economics, are such that you will more than likely come out way ahead by leasing than if you were to sell the asset, take the money and put it into a bank or pay off a bond. And that's because the developer's cost of capital is so much higher than the city's cost of capital that they can afford to pay you a higher rent and make you more money, and it still makes sense for them. That's really it's that it's that differential that is the key. That developer equity is so expensive, 15 to 20% a year, versus the city's cost of capital, 4 or 5% a year. You can meet in the middle. Everybody wins.
I have a question that is happily not a bond question. About 4 months ago, the City Council had a very spirited discussion about Adams Street, and that question dealt with the term highest and best use. And I believe that the Council came to the conclusion that that's largely a financial item. That is, Adams Street, the highest and best use was whatever number of dollars you could get from it. You've used the term here as well. Could you speak to your sense of what highest and best, highest and best use means?
So it depends on the client's objectives. Many organizations use financial return as the measure for highest and best use. It is not by default the best use. There are public policy goals and objectives and other issues that have to be factored into making that decision. So we're definitely not implying that the use that generates the highest value, dollar value, is the best use for the community.
Thank you.
I have a question. Oh, did I get in front of you? On the last slide with the new tools, the sustainability and housing districts, can you speak to what the benefits, some of the benefits are of those tools for us? Or what they might be?
A lot of them have to do with the fact that California legislation is trying to help communities bring housing to their communities, because we know there's a gross shortage of housing. There's also specific shortage in affordable housing. There's specific shortage in workforce housing. So some of these legislative tools, if you look at most everything on the new tool side, you can almost point to it as being the evolution of what we call economic development after redevelopment. And I know that this isn't a big redevelopment, project area per se in terms of St. Helena, but the point is that redevelopment was this tool in California that was being used to improve communities, to eliminate blight, frankly, to bring housing and allow for affordable housing. So many of the laws that have been passed post-redevelopment, and we were 4 years without the ability to leverage tax increment financing as a tool. Well, they started to come back from the laws out of Sacramento, including EIFDs and CREAs. CREAs, is really a tool that's a lot like redevelopment. It's a tool that requires 25% of the income stream that's being used, the tax increment, for affordable housing. So these other tools are brand new legislation that, again, is really trying to allow communities to create districts and create environments that are sustainable and that have more housing that's being offered to folks so they can afford and live in California, which is a tough place for that to happen.
Thank you.
But do you, what's your opinion as to what extent any of these are really applicable to us? Given our situation and a little bit that I'm sure you've read about our town and whatnot.
That's exactly the point, is that it comes down to what is important. Are these tools applicable to you? Maybe, maybe not. But so it's a broad brush. What is important at the end of the day? That's part of the point. You have your properties and your community, your needs and wants. And then you're going to come up with that decision. You're going to say, look, this initiative is important to us. We need to get this done. If there's a tool that makes sense to utilize, great. If there isn't, and we're not suggesting you should just go off and create a whole community of affordable housing. You may need it, but you have some tools to use if that's the direction. If you have an infrastructure problem in trying to improve some of your properties and areas, there's ways to create infrastructure districts to pay for some of that. That's that tool. So that's kind of the point.
But do the infrastructure districts have to be voted on?
In the case of EIFDs, no.
Okay.
They do not. In the case of the that's to issue the bond. You can create a district. You can create any district and have it in EIFD. To issue a bond, you need voter approval of the property owners within that district. For a CRIA, you need voter approval to create that district. So there's distinctions there.
And so what's the benefit of creating the district? You get to tax the folks that then own property in those districts?
You don't tax them anymore in the case of an EIFD. It's you use the tax base that increases, that revenues would have come to the city, and you use that to finance infrastructure. So you're not increasing taxes. You're using
to finance infrastructure within their district.
Yes. But actually, you don't even have to do it within their district per se.
So what's the difference then of just taking the increases in revenue and property taxes that we're getting and
because you're being very specific when you create an EIFD that's the intent, and you have a very specific plan that you write that says I have a $4 million need, and I'm going to use the increment from this district specifically for that need.
So at the same time, it locks you into something too.
Yeah. Right.
So
it's basically a way of showing your commitment, showing your commitment to the community that we are serious about doing this, and here's the plan to do it, as opposed to setting aside, because you're right, you're taking the same money that you would otherwise have in your general fund, but you're locking it into a binding commitment for 20, 30-year period.
And the whole, again, back to redevelopment, that's what redevelopment was. Without redevelopment, you had no right or ability to do that as a city. You could take your tax increment and make a decision, but how long does that last? You're creating a 45-year district with an EIFD, creating it. So it starts to feel a little bit more like what redevelopment was. And then within that district, very specifically, you're taking the increment as it gains, and you're using that for the financing. And ultimately, you can issue a bond accordingly. That's really what we're doing in Laverne down in Southern California. Be one of the first CIFDs. Transit-oriented, infrastructure needs, there's a whole story there. Again, it's not perfect for every community.
Yeah.
I'd just like to comment on the new tools that Mark just asked about. When we initially started this committee and got our notebooks, we had a chapter on affordable housing, and we haven't talked about that at all because we've concentrated on the physical assets that the city owns. But I can see how these tools are very applicable to the city of St. Helena, and I can even see places where these tools could be used. So I'm glad to see them.
Okay. Thank you.
Back at the beginning when you said, and I agree that, you got probably the biggest issue is defining needs and prioritizing community needs. That wasn't just about space, though, right? That's also about the uses that the community and the services to the community. It's not just a spatial thing.
It's not just a physical
it's
plant or facility issue. It's community needs or needs and wants.
Right. Okay.
Yeah.
Can I ask about, it's like an enthusiasm meter from your experiences in other facilities, building a swimming pool for the community versus a city hall versus a fire department versus a baseball field. I mean, is there a lot of enthusiasm for building a city hall versus a community swimming pool? I mean, so much of this financing is based upon the sellout to the sell job to the public that they're going to buy into this with, I can't wait to build a city hall. Yeah, raise my taxes. I'm so excited. I mean, what's the reality about, how these apportion out?
I think how many cities deal with that issue is that they build a city hall as part of a larger community civic center, maybe libraries, community space, a swimming pool. I mean, you do 3 or 4 things, and it's kind of like you get, if you want this, then you got to give us that. I think it's how a lot of cities end up dealing with that.
Yeah. I want to just, because I was thinking of something when you were talking about your enthusiasm meter and, how enthusiastic are you that you want to be taxed to build a new city hall, but there's also another way to look at this, is that we didn't tax ourselves for the last 25 or 30 years to save up the funds to build a new city hall or to keep the city hall in good shape. So we all were paying a whole lot less in property taxes because we weren't spending the money in the past. So I don't know. I did a lot of fun things with all that money that I saved, so I'm okay with maybe having to be taxed a little bit now.
You don't have to sell me.
Okay, that was even more for the benefit of everybody. I mean, because again, if we end up doing a general obligation,
I think it's important that the community, everybody understands that you're not building a new city hall as a monument, but you are doing it to protect the health and safety of your employees and their visitors that come to City Hall. Because if something happened, you have the liability issue of somebody being injured by roof tiles falling on them, et cetera. So
this is maybe a little bit of these next 2 questions are maybe a little bit loaded questions and putting you in an unfair spot. But to the extent that you read the EMG report, and I guess, do you have any comments on what they came up with for rehab costs, and do you have any comments on the appraisals that they came up with? And I would, well, anyway, I will give you your own out. You can come up with your own if you want to. But.
I would say we appreciate the difficulty of doing cost estimates, especially in a community like this, and so it's likely that they were optimistic in terms of the level of the cost that they were expecting would be needed. That costs, repair costs, in our experience, are usually a lot higher than originally estimated. As to the appraisal, we really haven't had a chance to understand all of the market conditions, but having read through them, they seem to be done in a professional manner. That the methodology was sound in my opinion.
But I noticed I can't find the place now. They evaluated City Hall at $3.3 million, and in your material here, I'm trying to find the page. You evaluated it at $5.
No, that wasn't my estimated cost to replace a brand new building.
Yeah, right.
Yeah.
Same thing. For them, it was 3.3.
No, I believe the 3.3 was the estimate of the value as is if you just were to go out and sell it to a private operator that wanted to have an office building.
I think we put, I don't know whether that, 3.3, but well, that's just on Fernando's thing.
Yeah.
And then
Yeah, you're right.
Yeah.
Okay, so
We
I
put
apologize.
this
We might have had our numbers mixed up there. But obviously, the building is worth a lot less than what a brand new building would,
Of course.
if you replace it.
Can I just say, I almost feel like I'm going to a therapist where the therapist has the answer but won't tell me. And you,
are we? Are you saying
you guys
we're the
seem like a
therapists?
couple therapists to me?
Okay.
You have the answer for this town, and you're holding
Well,
back.
we still have another hour.
Well, I know.
Understand it. So, I mean, and these things aren't done just overnight, So, but we're available. We're
Okay,
around.
I'm just curious.
Well, and plus we have 2 more office visits apparently.
Yeah,
that we've
right.
already
Well, we
paid
don't
for.
want to give you the punchline too soon in the therapy session.
Which brings up another question. Maybe this is jumping ahead and it hasn't been fully defined, but what are the plans for the next 2 visits? Are we going to throw scenarios at you and you're going to tell us how they could be financed?
I can comment on both of those. First, just a comment on some advice that I gave them before tonight is that we weren't looking for their ideas specifically tonight. We wanted you to ask questions, but certainly if you have ideas that you'd like to bounce off of them, we were hoping and anticipating that those would come from you rather than they recommending. But as you move forward, the vision for the second and the third visit is that for the second visit, you will probably have had an opportunity, you will have an opportunity and likely will have some things and configurations, options that you're thinking about. And you will have refined your thinking about the various assets and priorities and so forth, and that will be an opportunity to ask additional clarifications and recommendations, and we will also have an opportunity to ask them to run numbers on these various ideas. So from a timing standpoint, next week we will begin discussing decision making, talking about priorities. We will take the week of the 21st off. That's the meeting. That will be the week where we have 2 community meetings. And then on the week of the 28th, we're anticipating bringing you the long-range financial forecast data. I'm going to ask for a few volunteers related to that. And after you have met, we are holding March 7th at the moment for round 2. And we don't have a date that we're holding for round 3 yet. But at the moment, March 7th is the date that we anticipate them coming back.
Any more questions?
I think also, I think today was a great opportunity for us to also, as we mentioned, to tour the properties. And so in our minds, we're also going through that process of what's the potential, again, of some of those pieces to that puzzle. I think, putting it together ourselves as well. So it's helpful for us to digest some of that, frankly.
There was also a question earlier about the cost of the general obligation bond for the fire department. I believe it's
About 2.2 million, and the interest was 5% to 6.75%.
2.2 million, and the interest ranged from 5.6%.
5% to 6.75. It was very. It was
5.5 to 6.75.
And that was built 25 years ago?
1996, and it ended about 2 years ago.
Okay.
And so just so you have it on your video, just for you, Allison. So it was 1996 general go bond issuance, so it ended about 2 years ago on that one. And the only other debt that the general fund currently has right now is the Adams Street property, and that is scheduled to be paid off in 2021. So right now, as stated earlier, we have virtually no debt on the general fund. Fiscal year 19, it's about $150,000 payment. Fiscal year 20, about the same. Paid off in fiscal year 21 with $70,000 for the final payment on it.
And
What was the total on the Adams Street property?
I don't have that one right in front of me right now.
do you know what the outstanding amount is on the Adams Street property?
It's just about $360,000
Okay.
for Adams Street. And that's for principal and interest.
Okay.
And that debt's been paid off through the general fund over these many years?
That is correct. The GO bonds, the general obligation bonds for the fire station, that was an assessment on the property tax rolls. And then the other one for Adams Street property was strictly from general fund.
So
Theoretically, just a base that the city can absorb, apparently, over all these years.
2.5 plus what Adams Street property was, say that's
I would not feel comfortable answering that right now. I'd really want to wait to see what the market looks like, see what our debt capacity is. We haven't run any of those models yet.
It would be useful, though, because then we'll know what we need to borrow beyond what we know we can do without borrowing an addition.
Absolutely.
We should open it up for public comment, though, if anybody has anything they want to ask of these guys or us related to this topic. Yeah.
If I can get over there.
Yeah, you got it. Yeah,
Can't hear you on the phone.
yeah.
I had a knee replaced a couple of years after I said it. It doesn't want to wake up and work.
My name is Lowell Smith. I've lived here for 52 years. Came to town and built the A&W in 1964. My question, I guess, of this is, as a Warrior fan, watching the Warriors nearly every 30 seconds now, they're showing the Chase Center being built in San Francisco. And San Francisco brags about that's all private money. Of course, Citibank stepped up and bought the name. Do any small cities do anything like selling naming rights? Or we have one example. Dr. Wood gave us about $5 million to buy an endowment fund for the library. So we obviously named the library after that. And we have at the other extreme, bricks you buy in a number of places in town for $300 with your name on it. But I guess the point is, are any small cities using the dynamics of community enthusiasm, if you want to call it that, for naming and naming rights, and specifically to encourage specific investors? Because fortunately, we do have a lot of very well-to-do people in this area, and many of them are very, very philanthropic about everything, but particularly about this community. And I would hope that there would be those that say, why sell a bond issue for $5 million? We can find a way to help you. You may have to call it whatever name, but the point is, there are folks around this Upper Valley got a lot of money. Is this an opportunity to leverage that?
Yeah, no, I would say that there certainly is opportunity for that, given, one of the statistics we talked about earlier in the presentation was the 3.5 million people that come to the valley each year and probably spend $3 to $4 billion a year. I think there would, even without the philanthropic aspect of a naming rights, I think there could be companies that would want to get their name out in front of that group of visitors, and in terms of a quality facility to be able to show. Now, I've not heard of naming rights for a city hall or whatever, but I mean, in terms of other type of community facilities, that certainly would be a possibility. And then clearly, from a philanthropic perspective, having individuals that want to, donate something for the community and giving them credit publicly is a very common practice.
I've heard there's some people that are willing to pay for some roads if the street name is changed. Anybody else have any questions or comments? Okay, I guess we'll close public comment for this item. Thanks, you guys. Appreciate it. The next item is public outreach and marketing update from Mark.
So this is a short item. I wanted to take an opportunity to revisit the conversation that was raised at the last meeting regarding video ideas. But just to kind of back up a bit, in terms of how a couple forthcoming events, the concurrent community workshops that are scheduled for the week of February, it's February 21st and 22nd, those, we have developed a very nice flyer, courtesy of Allison. Thank you, Allison. And that flyer is being distributed around town. It's on our website. It was emailed out to, I believe, about 5,000 email accounts, and it is included in the quarterly quarterly city newsletter that will be going out next week, and should be received by residents before that date. So that's a vision there. So in terms of advertising for that, we have a lot of awareness, hopefully, of those forthcoming workshops. I guess the bad news is we can only fit about 400 people or less in the room. So, but we're anticipating a pretty good crowd, and we're going to be doing a very similar exercise to what this group went through at the last meeting, which you have handouts from tonight. And that will be those tools, and we're also using social media, Facebook pages, etc. Those tools are going to continue to be employed as we continue to advertise the work of the committee, and also see community participation in the workshops and eventually the focus groups. And I think with the attendance today, we can see that the crowd is following you and growing. So good to see the turnout tonight. In terms of video, the committee doesn't have a formal budget for video. However, there are some modest funds available in the city, and if there's interest on the committee's part in putting together an informational video, not a video that would advocate any specific recommendation or observation at this point, but just really reinforce the expectations of the council, I anticipate that we would be able to work on something like that in short order. And so what would be helpful for me is to have a couple of volunteers help me put together a script and evaluate some options. There were a couple of you that offered ideas on a videographer, for example, and we've had some internal conversations about other options that may be quite affordable. So if there are volunteers, I'm happy to work with you to talk about some ideas and then work on those very quickly.
Mark, I thought there was a lot of enthusiasm when we came back from our small groups. And is it not possible just to take that, to stream that onto something and use that? Because everybody was very relaxed and people had some good ideas and they were enthusiastic. And then you wouldn't have to go back and redo it.
And I think there may be an opportunity to use some video clip from the feedback there. That was a really good session, and I think a good wrap-up to the work that was done at your last meeting. And so I don't know about the quality of the video that we used that night, but if it's of a high enough quality, then certainly those would be clips that are available. And we would need to work on a relatively short duration that could be used as a cameo type production or something on the city website, etc. So are there a couple of volunteers that have an interest in video potentially? Okay. 1, 2, and I maybe saw another hand over here. Third? Okay. That's very helpful. I do think video is a nice way of communicating and just adds to awareness of the work that this committee is doing. Are there any questions about moving forward related to publicity and reaching out? Because from a timing standpoint, we're about to turn everything over to you. So when we come back to you at the next meeting next Wednesday, the focus will be on decision making, and we anticipate beginning to dive right into that, which will likely deal with prioritization and talking about criteria by which you'd like to evaluate these items. So that will be the focus at the next meeting, followed by the workshops, followed by continued decision making and information related to the long-range financial forecast, as well as updates related to the EMG study. So remember that that study was a draft study, and the feedback that you provided, particularly related to costs, is something that we are continuing to work on. We've received some information from the City of Napa, which is the city is actively working on building the City Hall, and their numbers were substantially higher than $285 a square foot, which is the number in the original draft of the EMG study. So I'm anticipating that we're going to have some updated numbers to share for you, and that does influence our long-range financial forecast. So again, some of the final numbers will be coming probably near the end of the month, and then you'll have the entire month of March to work on decision making, as well as into April. So a lot of time dedicated for building options or consensus around various priorities.
Are we going to get maybe some more refined, I guess, space need numbers? It didn't feel really very strong to me that those numbers, I mean, I guess maybe, or if you and your own staff commented on what you thought about the space, space numbers for various, services and support, needs that you guys have. I just would like to feel a little stronger about how big does City Hall need to be, what needs do we have, at the library, does it need to be expanded, does it need to be expanded, that sort of thing. Because obviously that's a big factor.
I think we'll need to give it more consideration. The numbers that were used in the EMG study were largely similar to the numbers that we have today, and I again don't anticipate much change there in terms of staffing size or space needs. So I think they are in the order of magnitude that we'd be looking for. But again, I think I've heard that same feedback from others as well, and I would anticipate that we'll give it some additional thought between now and then.
Place that I had a problem with that same thing is that they said like 250 square feet for an office and 80 square feet for a cubicle, but I don't know how many employees at City Hall require an office and how many require a cubicle, so it makes it difficult.
We gave it some high-level thought because I wouldn't tell you that City Hall is configured in an optimal way today. It isn't. But we gave it an educated guess when we were looking at those numbers to try to identify square footage and identify how many would be in need of an office versus a cubicle and the size of the cubicle.
Also, the departments that need to be there, Public Works, do you need the head of Public Works to be at City Hall, but the rest of the staff someplace else? And of which departments need to be there and which departments don't need to be there, would be better off if they're not there?
And in the spirit of talking about the marketing for the building, I think we'll bring you additional thinking on the topic so that we can bring that back to you at a later date. And the short answer is I like everyone at City Hall. But there are other configurations that work in other communities as well as this one.
Mark, in the meetings on the 21st and 22nd, what information is going to be shared with the attendees before they start giving input?
So the format of that workshop, which we are advertising in lots of different ways, this is how I tie it back to the item on the calendar, is going to include an overview of the responsibilities of this committee. So we're going to talk to the community about what the charge is, what's your mandate. And we're going to share with them some information about the EMG study, basically the evaluation of the buildings, the numbers, the best numbers that we have at the moment regarding the deficiencies of the building and the estimated costs over the next couple of years, over the next 10 years, and any additional high-level type data related to the buildings. And then we're going to walk them through an exercise that's very similar. We'll probably ask a couple of different questions, but they'll be then fairly in short order, put into the same kind of conversations that you had about the assets. So people that will be attending that meeting, they will know of these buildings. They won't know them as intimately as you, I don't think, but we'll get some good feedback and inventory that feedback and bring that same feedback back to you at a later date.
Any constraints on our attending as observers?
That's a good question, and we actually talked a little bit about that today because Jean, our facilitator for the workshop, is here, and worked also with Allison on that today. We're not anticipating having a role for you at the workshop, but that doesn't mean that you can't attend. But it does mean that you would not be able to actively participate, and so you would be observers if we don't schedule this as a special meeting of the SHAPE committee, and that's the vision, is that it's not going to be advertised as a special meeting in the SHAPE committee that requires everyone to start the meeting and conclude the meeting and have a specific agenda item. But it does allow you to, even though it's a workshop that's run by the staff and the consultant, it doesn't mean that you won't be able to attend. You just won't be able to actively talk about the product that they're working on.
This is a comment on the previous comment. Excuse me. The EMG report, are you including that in the marketing material, pointing people towards the copies on the city website? It might be a good idea for people who are coming to have had a chance to review all of that, because there's quite a lot of information there to absorb.
There is, and at that workshop, and thank you for mentioning the website, because the website inventories every document that you've ever been given. So we're building a very nice bibliography on the city website. And at that meeting, at the community meeting, we will have a list of every item that you've ever seen. It's going to be a list on the wall or on multiple walls that tells the folks that are there everything that's available on the city website.
Are we going to be taking down any demographic information from the participants so that we see whether we're actually getting a good cross-section or not getting a good cross-section?
That's good feedback, and we will note that, because I think that would be very easy to capture.
Yeah. And then the other question I had was, to what extent, because to me it's kind of a little bit of the elephant in the room, to what extent are you guys going to be talking about Adams Street at the workshops?
We're not necessarily, Adams Street wasn't part of the EMG study. So
no, I know.
So
but this is a workshop about community input and what they want, and
we're looking at the same questions that you were asked at the last meeting, and so that's really going to be the starting point for the conversation. They're really, if people want to provide feedback on Adams Street, we can capture that, but it's going to be an exercise that is very similar to the exercise that you went through. We're looking for feedback on the various assets. We're going to share with them the condition of those buildings, the assessments that were done, talk to them high level about that, but we're not specifically asking about Adams Street, but it could obviously come up in the context of the discussion, and I think it's referenced probably several times in the notes that you received tonight.
Along the same lines that Mark has, in our next meeting, when we start melding all of these separate groups together into general ideas that we've all had, and then we can all start to begin to think about that. At that point, are we going to be talking about Adams Street? Because, as you say, that is the elephant in the room, because certain elements of the city properties that we have now will be used in different ways. If we have a great idea for how we see as the city Adams Street should be headed, then we'll know better how to finance all of these and how to build what we're going to build. It's really part of the overall picture, even though there's no real facility there. All other facilities need to be wrapped around that, too.
So the committee is going to control the discussion moving forward. So you're going to discuss whether Adams Street should be in play or not in play. You're going to control the vision for these various assets, including that particular one.
Okay, great.
I had one comment for the group that's going to come in, the focus group. There's a whole bunch of stuff they're going to have to drink real quick to be able to have any kind of opinion on anything. So one tool that might be really helpful is to have a larger blown-up map of the city that we see in a lot of these reports that shows where the different assets are at. And then by each asset, you could have a title of what the property actually is, the size of the property and the building, the cost, the appraised cost, and then the projected cost to fix or cure, and then what the use of those buildings are. So that when somebody looks up, they can go, oh, there's the green building on the corner of Fulton that I drive by all the time. That's this, and that's what they do, and that's how big it is, and that's what it's worth, and that's what it is. And then they can start looking at the puzzle more clearly in a shorter amount of time than trying to pour through 3 different reports and assemble everything and hook it all together, which is would be very difficult to do. And so I think a pictorial of that would be helpful for them.
That's a very good idea.
Thanks.
And I recognize that you've had an opportunity to tour every building. You've spent hours on the tour. You spent hours already listening to data related to the condition of the buildings. I mean, you've done an incredible amount of work, and we know that you are intimately familiar with these assets at this point, and you're really ready to have that conversation. And the good news is it starts a week from tonight. Okay.
That was our last item. I don't know if anybody all of a sudden thought of something they want to throw it out there, if the public has any comments. Otherwise, meeting adjourned.